As I'm recording this today, which is Thursday afternoon, the markets have been sending us a very interesting set of messages over the past few trading sessions. We definitely have been seeing a certain amount of freaking out regarding the potential imposition of Mexican tariffs as early as Monday. As of now, the market's of a mixed mindset about it. They're certainly afraid of them, and we're right to be, certainly when the president kind of brought them in out of nowhere. Now with some opposition from the Senate, it's less likely that they're going to come into play. But you do sort of have to wonder in the backdrop what's out there, especially as the rhetoric remains very tough. So we saw a knee-jerk reaction to the downside, which was expected in equities. A knee-jerk purchasing of bonds, yields falling, prices rising, and that sort of reversed itself on Tuesday. The Fed chairman made some comments that were conciliatory, I guess, at least of the sense that the market wanted to hear. The market loves reassuring tones from the Federal Reserve. And we saw a huge rally in the equity markets, which persisted into Wednesday, and again, as we're taping this Thursday afternoon, is persisting slightly into Thursday. Although the breadth has not been great, we haven't really seen an overwhelming amount of advances over decliners. We have just sort of seen the markets churning higher over the last couple sessions. As I look at it today, the markets are actually telling a bit of a bifurcated message. And when you get something like this, it's a very difficult environment to trade in. And here's why. Again, looking at this at Thursday afternoon, we are seeing continuing rallies across the fixed income space. 2-year, 5-year, 10-year, depending on where we are at any given moment, there are various inversions along the curve, certainly 3 months on out. Spots, the 2 and the 5s are very flattish, and depending on where you look and how you strike your inversion. The market is certainly looking for Fed ease at some point, which is when you see an inverted yield curve. That is a very recessionary viewpoint. An inverted yield curve basically is implying that you're going to get continued rate cuts from the Federal Reserve because inflation is going to be more or less non-existent, and the economic conditions are going to warrant easing. Yet, that really shouldn't be very good for stocks overall, but somehow the stocks are managing to ignore it. The stocks are taking away the message of, well, the Fed is going to be accommodative, the Fed's riding to our rescue, all's okay in stock land. But that's not really the case. There's certain sectors that are really being taken out to the woodshed. I was looking at retailers specifically, and those stocks, I guess with the exception of Amazon, which is which is considered as much of a tech company, wrongly so for many years, now more accurately so because of the cloud computing profitability. But for years it was considered a tech stock, despite just basically being an updated version of the Sears catalog. Regardless, retailers have been taking it on the chin in a big way. Looking at stocks all over the board hitting 52-week lows, Macy's, Kohl's, the fairly smaller cap At Home down 50% on an earnings miss. I find it very difficult for the stock market to rally in an environment where the market is telling you that the consumer is not participating. And that really becomes a conundrum, and this is what makes this a very difficult market to trade. In short, if you're getting one message from the bond market, you're getting a different message from the stock market. The one thing I'll take away is over time, the bond market tends to get it right. Although, and there's always an although, I think the bond market's gotten a bit ahead of itself as well. This is a very tricky market right now. And if you can get a clearer message than I can, good, that's great for you.